Here we go. Hey, awesome. Hey, my name is Jed Barker. I'm with Best Life Mortgage. I'm here today with Ryan Kelp. He's with Ultra Revival. I met Ryan just over the phone and video calls, maybe like a year or so ago, maybe 2 years ago. But I tell you, he's been a big blessing in my life. I have multiple stories I can share about my clients that I've sent to Ryan that either they got the deal done because of him and his team, or we got way better pricing on our interest rate and saved thousands and thousands of dollars. And my job and what I mostly do as a mortgage person is help fit people in to achieve their goals of home ownership with the right loans and really explain that process. And before Ryan came into my life, I was searching for probably 5 years for a really good fit on credit. On credit, I had tried like so many different people, and really no one came across to me as someone I could trust and be a real partner. But Ryan did. And so just a quick intro to Ryan. And today what we're going to talk about is some specific things that I think my clients can do as they're watching this to get ready to buy a home so they get the best rates possible and the best mortgage payments. Because I know that's important to my people, is to have that with everything really high right now with interest rates and that, like doing everything you can to get the best pricing and achieve your goal. Super valuable. But Ryan's with Ultra Revival. He's the owner and the businessman over there. He does consumer finance and specifically home loan preparation, which is what I really love about Ryan's business. They focus on home lending as opposed to just general like credit repair or something like that. It's all about achieving goals. And Ryan has a book. I might mention that later, but hold it up, Ryan. It's called The Credit Movement. It's on Amazon. You can find it. He can talk a little bit about how that can like maybe bless your life and help you as you achieve goals in financial stuff like that. But I want to throw it over to you, Ryan, for a minute. Maybe just anything I missed.
No, I think you hit the nail on the head, Jed. About 20 years ago, I was living in Denver, Colorado after college, and I kind of fell into this industry of consumer finance and credit restoration, credit optimization. And where I found a really big need was in the space of home loan preparation, right? It's where it's the biggest purchase most people are going to make, right? It can be a stressful process, not so much if you have a good partner and lender like yourself, but it can be a stressful situation for people and confusing, right? And then that doesn't even tap into once you start looking at the credit report and trying to figure out how to make yourself optimal, right? Because every 20 points, there's a new tier, you get different pricing, and it can get a little bit wild. And that's why I like being with partners like you who take the process seriously and explain that to your customers. Like, hey, I could get you in a loan here at this 702 score, but if we get you to 740, we have 60 days to close. We're going to save you another quarter point, reduce your payment this amount, and I appreciate that about you and about a lot of the partners that I work with. So I kind of, it became a passion and a calling to me to say, hey, I want to really focus specifically on folks that are trying to purchase a home, and wrote books on the topic, public spoke on the topic at National Association of Realtors events and the National Association of Mortgage Brokers, and became an educator on the topic of credit and strategies to optimize credit reports and scores. The scary thing, Jed, for people watching this and for potential home buyers and borrowers is that 79% of credit reports have errors on them, right? And that's things that people aren't even looking at, right? It could just be a simple date of last activity, or a balance or whatever, but that every little point matters, especially when you're under the microscope of mortgage underwriting and that sort of thing. So what I've done is just develop tactics and strategies to really help people get the best position possible to not only, get qualified, as you mentioned, but get qualified for the best loan possible.
Yeah, that makes a lot of sense. I have a borrower this week. I was talking to him on the phone. I always ask, a lot of times, I don't always ask, but I asked, do you know what your credit is, like about where the scores are? He was very quick to say, oh, I have 780s, we're almost perfect credit, everything like that. And it was him and his wife. I did have to, check his credit for the approval. And he had a 780 on one bureau, and he had like 660s on another bureau and like 680 on another bureau. And so I looked at it myself, and he has really great credit, like super young. He's a young guy, but really, really just mature, financially. But he had $100 collection from like Charter or something on the two bureaus. And he didn't know about it. And what people don't realize, I think, when I'm talking to them for the first time, is that there's a big difference between a 680 and a 780 when it comes to financing. It's a lot of people just think about interest rates like, oh, well, that's going to be a higher interest rate, so my payment will be higher or whatever. But what they don't realize is there's a dollar value put to that, and
Yeah.
it's probably about a $6,000 cost for him to have that lower interest rate if he wants to keep the mortgage payment, and that's something he didn't know that was on there, and most people just don't get that. They just hear someone say to qualify you need a 620. What they don't know,
Yeah.
20 might get them a loan, but maybe they won't afford it. You know,
You're
like
right.
20, maybe they can only afford it at a 680 because the payment's that much higher, that kind of
And
thing.
it's not, and that's not uncommon, that people aren't aware of a certain thing that might be hindering them. But more importantly, people get misled by the scoring, right? Because I
Yeah.
always tell people if you go to 100 different places, you'll get 100 different scores, right? And the
Yeah.
only ones that matter are FICO 2, 4, and 5, which are the Fannie Freddie approved algorithms for mortgage lending purposes, right? So people come to you and say, and you hear it probably, and that's where I want to educate the listeners here is like, you're wherever you look at your credit, that doesn't mean that that's your score. Like
Exactly.
Experian, Equifax, and TransUnion don't calculate scores. I use the analogy of like, think of Experian, Equifax, and TransUnion as a hole in the ground, right? As a
Uh-huh.
swimming pool, but it's empty without information being dumped in. Well, what happens is Capital One and Citibank and any collections you might have, they report data. They dump that bucket in once a month with you and every other consumer's data, right?
Mm.
So when somebody goes to request a credit report and score, whatever, they siphon that water out and run it through an equation to calculate and come up with a number. Well, everyone has a different siphoning system, a different calculator, right? So when you pull it, you're using FICO 2, 4, and 5, which are, again, Fannie and Freddie approved mortgage algorithms
Yep.
that have been around since the 70s. FICO 9, which is what your Capital One app or your Discover app is going to give you, is a very different algorithm, FICO 9, from your algorithms. Credit Karma is a Vantage 3.0 score, a very different score, and that's where a lot of people get
Yeah.
misled, or they come to you and it becomes something you have to deal with, Jed, right? It's an objection you have to come across
Yeah.
or overcome, because they say, hey, my phone app tells me I have a 761 credit score, and you're like, I'm sorry, Charlie, it's a 647,
Sure. Yeah.
you know what I mean? And it's something that you want to be able to explain to a potential borrower to say, hey, just because you see that score, that doesn't mean that that's your mortgage score, right? So that's
Yeah.
important, I think, for the listeners to understand where they're getting into the home buying process.
Yeah.
And not just that, but just understanding that I've seen people with bankruptcies where they discharged hundreds of thousands of dollars of debt through a bankruptcy.
Uh-huh.
And that was a year and a half ago. And their score is higher than the one you referenced that has a recent $100 collection, or
Right.
they missed a $22 minimum payment on like a Best Buy credit card.
Mm.
Like
Yeah.
that is more detrimental based on how recent it is than somebody who literally defaulted on hundreds of thousands of
Wow.
dollars of debt a year and a half ago. That's why the system's messed up. That gives me job security, just understanding
Yeah.
how to help somebody back to get
Yeah.
themselves in a position where they can qualify, and you get
Yeah.
them the clear to close, which everyone
Yeah.
loves to hear, right?
Awesome, man. Yeah, that's some good nuggets. So, what I'd love to know, Ryan, is if we could share just within the time we have, like maybe a couple really good nuggets for people, help them as they're in their journey right now to prepare for a home loan. Because my
Sure.
clients are either just preparing, they're not quite ready, they're getting ready, and they have some time, or we do run into a lot of people who are like, they're actually going to place an offer on a home or already have, and they call me and they're like,
Mhm.
hey, I need to get a mortgage. Can you
Right.
get me one? But they're already in contract, and now we're on a very tight frame. So what are some nuggets as your professional opinion that you could share with some of my people here that will help them get ready? And then what are
Yeah.
some things maybe in the short run, if we're on more of a time crunch, like what are things that could be done to help people boost their scores up to get better pricing, stuff like that?
Yeah, absolutely, absolutely. The first place I always start, and if you want to share screen,
Yeah, sure.
Jed, the slide I put up, this might give some visual context to what I'm talking about. But the 30% amounts owed is, where I always start, right?
Okay.
Because, this gets a little complex where I'll talk about what is, considered revolving. Well, the main thing that most people are going to think about is going to be credit cards, right? That's revolving, meaning the payment changes each month. But one other thing that factors in there, this is important for clients that are looking to maybe refinance or buy an investment property, is that if you have a home equity line of credit, it's picked up in the algorithm just like a credit card. So if
Oh,
you have an
wow.
interest-only home equity line of credit, that let's say you took out an $80,000 second on your property, and you're only making that interest-only payment, and your balance is $80,000, it looks like a $80,000 maxed out credit card as far as this algorithm is concerned. Well, I've
Mm,
perfected a method to go to places like Tower Federal Credit Union and certain banks that are very notorious for backing these seconds, these HELOCs, and
yeah.
got them to change coding to show it as a collateralized asset versus a unsecured debt, right? With
Wow.
like a credit card, because that unfortunately that's just the way the other. It's just one of the many things broken with the system.
Mm,
So to answer your question though, in the short term, prioritizing credit card debt, right?
yep.
Because it's so detrimental. But understanding how to prioritize, right? Because my goal is always for you to put as little money out of your pocket as possible to have the biggest impact on your score, right?
Yep.
So somebody, I just looked at a credit report earlier, Jed, and they had a $30,000 Discover card with a $28,000 balance on it.
Wow. Yeah.
Well, in order to get that into the optimal range, optimal meaning you want to be using 20% of your limit for just generic example purposes, $1,000 limit credit card, $200 balance or less would be considered optimal where you're not being hurt, right? So again, you take this 30%. It's important to understand that the scale that we're talking about here for mortgage scores is about 300 to 850. It's a 550 point scale.
Mm,
30% being about 165 points, right? 30% of that 550, right? Of that 550 point scale. So it's 165 points. That is how you're managing your credit cards. So if you have 3 credit cards, it's broken. It's not cumulative either. So that's important for people to understand. It's on each individual card. So you have to target each individual card. So that individual who has a Discover card with a 20, nearly maxed out $30,000, but they then, on the other side of that coin, they have a Capital One card with a $300 balance that
mm,
has a $280 balance, which is 20, again, they're about 90% utilized or
mm,
higher on both the Discover with a huge number and the Capital One with a lower number, right? So by taking $200 and placing it on the Capital One card, it's going to have the same impact as if they came out of pocket
mm,
$20,000 on the Discover card. Does that
mm.
make sense? So being able to understand that you got to target the smaller limit and balance cards first and get those under 20%. That's always the first place I start. I say, hey, let's just target those, because the minute we get those to report, and it's important to understand when they report to the credit bureaus too.
Mm,
And you can find that information out. If it's not on the credit report you're looking at, you can call them and say, when do you report to the credit bureaus?
mm,
Because here's another thing. I have people that come to me and say, Ryan, my score or the lender says I don't understand what's going on with this file, but I can't figure out why they're a 692 or whatever. This, again, a 587. I don't see a whole lot going on, but they have that $1,000 card that they use and they max out, but they pay
mm.
it off every month. But it's not reflecting that way, because when their payment is due is based on when they open the card. That's what sets your statement cycle date.
Yep.
So what I tell people is to find out when they report to the credit bureaus and always pay it down to show the smallest balance you carried throughout the statement cycle.
Mm,
Does that make sense?
yep.
So if, for instance, your card reports on the 15th of the month and you find that date out, make sure your card is showing 0 or under 20% by the 13th, so that once it cycles and they report on that 15th, boom. Now all of a sudden you got an 80-point jump in your score. You just went from 587 to 665, and
Huge.
you're in business then.
Mm,
So that would be where I would start, right?
okay.
Is prioritizing and managing the revolving debt, right? If there's derogatory data, a collection account, people think, well, I'll just go pay the collection. Well, by paying a collection, Jed, you're resetting the date of last activity, which makes that debt current in the eyes of the algorithm. Okay. So that's why I say don't pay a collection without removal.
Mm,
Because there's certain, and I could share a screen and show you, I have a whole global list of every collection agency, well, global in the country,
mm,
and I've dealt with them. So I
mm,
know who deletes and who doesn't. So we'll prioritize, again, as little money out of pocket as possible to have the biggest impact. Again, you could have a $3,000 collection, like a repo that's in a charge-off status or whatever this case may be. And people think, well, I got to target that. That's got to be hurting me really bad.
mm,
But it's 4 years old. as far as its date of last activity, but the date of last activity on a $30 copay from the doctor that, slipped through the cracks, that $30 collection, because the date of last activity is October of 2024, is actually hurting you much more than a $3,000 repossession balance.
Interesting.
So what I would say is, hey, let's take care of this $30. It's with an agency that we know deletes. Boom, that comes off, scores up 100 points.
Wow.
And they came out, because again, if the consumer, you would make the assumption that this repo with this big balance is hurting me much more, but that's not the way the algorithm sees it. They do not distinguish. They only distinguish based on how it's coded, 09, and that 09 coding is attached to a $30 medical collection, the same way it's attached to a $20,000 deficiency balance or repossession.
That's interesting.
So know that, and then know that the date of last activity is what determines the negative impact. So when I look at a credit report, because I've been doing it for 20 years, my eyes can go, and I can glance through it, and I can tell you within 5 seconds exactly what the game plan is to make this person optimal, And my eyes will scan, they'll look at dates of last activity, I'll look at the coding sections, and I'll just boom, 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 and in my weird brain, because I've been doing it so long, I can basically assess exactly how to get this person home loan ready. So just, again, understanding that, and then you combine that, Jed, with a knowledge and understanding of the Fair Credit Reporting Act and the Fair Debt Collection Practices Act, which are the laws that protect anyone watching this that has a credit report and score, right? There's laws in place, and understanding those and how to utilize those to get information corrected on the report is something that, I take pride in, as well as, I know, Jed, you and I were talking before the cameras were rolling about the Consumer Financial Protection Bureau. They're the ones who regulate the banks. They're the ones who regulate the collection agencies and creditors and data. So I utilize them pretty extensively and pretty successfully to remove items that don't belong on the report as well, which again is just going to boost the score and put them in a much better position to get qualified. So, and to your point, you used the reference in, when you introduced me in my bio, so to speak, as home loan preparation specialist. And why I like to be referred to as that is because I understand DU, desktop underwriting, I understand LP, I understand underwriting in the things that you as the mortgage professional have to deal with. You have skills that I don't, in capacity to structure a loan for somebody in a creative manner that is going to suit their needs, right? And I don't need to know all of that. I just need to know from a credit standpoint, a debt to income standpoint, what exactly these people are looking for and looking at. And I've studied it. I've got a mortgage license, although I've never done a loan. I did it just so that I could put myself in your shoes and the consumer's shoes to know how can I best serve them so that they can get to their ultimate goal. So, yeah,
that's pretty awesome. One thing that sort of hit up there maybe as a key point for people, again, is if your score, you come to me and you're talking about mortgages, and let's say your score, you have a credit score, obviously, and it's like a 660 or 670. Any mortgage person might just go through the numbers and say, hey, you're approved, it looks good, but they won't take that next step a lot of the times, which is, let's look at the credit report and see if we can have someone like Ryan take you from a 660 to a 700. And how quickly would that happen? Now, a lot of times there's not enough time for that with some people that are in contracts. They just don't have time to move it. But a lot of people are just preparing for home ownership. Like I'd say 50% of the people I talk to are not going to buy a home for about 3 to 6 months. Like they're preparing. And why not prepare in the credit realm? Don't just look at your score and say, well, I'm good. I mean, I can get qualified. I got this credit score. I don't need to do anything. What if during that 6 months you went from like a 660 credit score to like a 760 and you had like $300 off your mortgage payment every month? Would that be worth it? Like, would it be worth it to work with the right people? I think it would. I mean, that's what
$300 a month. That's $3,600 a year of after-tax money. Most people got to make $5,000 to make that. It's a 30-year mortgage. It's $150,000 is quick math for me, right?
Yeah.
That's $5,000 a year of pre-tax money for 30 years. That's $150,000. So it's worth it.
It's worth it. Yeah. Can this happen? Like some people, like they'll just go try to do credit repair, like the credit repair stuff on their own. And they might think, like you said, like, hey, I need to get rid of this old collection. And so it's on there for maybe 4 years, 3 or 4 years. And they go and pay it off. but now they have a worse score sometimes because they paid it off. Does that happen?
Because they reset the date of last activity. Yeah,
Yeah.
you know, it's hard because there's so much information. I mean, we're in the TikTok era, right? Where people have very short attention spans, but they want things done very quickly, and I understand that, and I sympathize with it. I'm the same way in a lot of facets of my life.
Yeah.
The issue is that people think, well, I don't need to hire a professional for this, which is fine. You know, I don't have a magic wand. I don't, you know, I've just done it for a long time, and I've studied the laws and different things, but people can do that the same way somebody incarcerated can read law books and represent themselves in court. They're probably, if they don't understand the system, though, that's where they're going to get, the prosecutor is going to beat them up. You know what I mean? So I don't know if that's the right analogy, but you get what I'm going for is like, yeah, people can certainly do this on their own. It's just, you want to make sure you have the right understanding, because there are some pitfalls. As I mentioned, you go pay that thing that you think is going to have a positive impact, and now the date of last activity gets reset. And instead of that thing having a date of last activity of July of 2021, it's now October of 2024. And the score just went backwards 65 points, and you're out the money because you paid the dang collection, you know? Or they pay the credit cards with the higher limits and balances first, thinking, I got to get rid of that high. That's not necessarily the right strategy, you know, where I would say, hey, and now they're digging into, we haven't even got into, you know, reserves and down payment funds and different things that are necessary. So I look at this strictly from, let's get you home loan eligible first off. And if you're eligible, let's get you in the best position possible given the time frame, right? Because again, I've got 500 lenders that I work with across the country, Jed, and trust me, there's ones that'll just slam any customer into a loan regardless. You know, it's like a bird in hand. They got a 660. I can get you approved. They'll stuff you in a loan, even though it's not the best product for you. Guys like you that I really appreciate working with is, you know, because I have something to gain. You're going to refer me people, but you're doing it in the best interest of the client, right? So if somebody has that 660, but you know you've got 90 days to close, like, hey, if you go work with Ryan, if we can sniff a 720 here, you're going to save $300 a month for 30 years. It's $150,000. It's worth the $500 investment to Ryan, you know, to go get this done, you know?
I remember a client of mine, they had about 45 days. They had 760 middle credit scores, which is really great. I mean, nothing wrong with that, but they really wanted to have the best pricing they could get, and 780 was the top tier. And so we went ahead and connected, and they got from 760 to 780 within the time frame, and they reduced their cash to close by about $3,000, because they were going to choose the same interest rate regardless. They were just going to pay more for it. They were going to pay more for it, right? And this was like a real $3,000 that they saved out of their bank account. And these are younger people that had to buy a bunch of stuff for their house and moving expenses and all that. $3,000 was a lot of money, you know, to them.
A lot of money. It's a couple of appliances or whatever, right? New washer, dryer, whatever, right?
And that didn't come close to the amount they spent on that issue that had to be repaired. Like, it was not that much money to get that done, but it was some foresight and, hey, we can do this. And they went into that knowing this, like, if for some reason we don't accomplish this goal, it's not the end of the world for us, because we're still buying the house. It's still good. But what if we were able to save $3,000? Let's do something with this. So that was a good experience for me to learn that, you know, and other people.
Absolutely, man. No, and I do, like I said, I appreciate that about you, because not only, you know, does it open up more referral opportunities to me selfishly, but also it really helps the consumer, right? If they're at a 660 and we can get them to 700 or 720 or 740, it not only helps them with the pricing on the loan, but think about what happens after the fact, right? They're going to need another car eventually. Well, they're going to get better pricing on that. They may need to finance some furniture or appliances or a new roof or solar panels or whatever. They're going to get better pricing on that. So it really sets
everything,
you know, the end user up, the consumer that we're talking about, the homeowner, for a better future. So I appreciate that about you versus, you know, again, there are some that'll just take that bird in hand and put them in the loan product that, again, with a little patience, we could have done better for them. So I thank you for that.
Awesome. We're about like 24 minutes into this. I don't want to go too much longer on a short video and stuff like that, but there's a lot of different things I know Ryan could, you know, discuss with someone preparing for home ownership, and not even just preparing for home ownership. This could be someone that wants to refinance to lower interest rates. So our interest rates have been relatively elevated for about 2.5 years, and a lot of people got into loans. And now they're going to want to refinance coming up maybe the next 6, 12, 18 months even. And these clients of mine want to have the best interest rates when they refinance. They don't want to have to refinance like over and over and over again per se. And so even if you're in a home and you're looking to refinance when rates start to come down and you want to make sure you're set up for success, looking at your credit now is what you need to do, because you might want to refinance in 6 months, and getting the best loan will be important for you for long-term savings and everything like that, as far as that goes. So sort of my closing remark on that is, don't go it on your own when it comes to credit. Like, really speak with someone. So would you finish up, Ryan, for us and tell us just briefly, what is the process of someone setting up with you? I want to flip this on the bottom of the screen. Here's Ryan's telephone number and his email address. I'm going to leave that scrolling, but what does someone do to get set up? And is that process like really strenuous, or is it like pretty easy?
Not at all. Not at all. I mean, typically what happens is you'll talk to Jed. He'll kind of preliminarily go through kind of where you're at in your timeline, and then he'll connect you with me via, whatever, a group text. It's 2024, a group text introduction, an email introduction, however that may go. I will send you a link. I can text it to you or email you a link for a soft credit check. So I have the ability to do mortgage score soft credit checks, which will give me all the information that I need. Doesn't hurt your score in any way. And then I can run an analysis and kind of give you high priority, medium priority, low priority timelines, things like that, as far as hitting certain tiers with your score improvement journey. And it's as simple as that. Then I send that analysis over to you. You'll get a link in that email to set up a calendar, a video call like this with me. And we'll go over that analysis, and I'll answer any questions and just make sure we're on the right path and the game plan makes sense from both sides. And then we're off and running. So it's as simple as that, just an intro. We'll do a quick phone call. I send you a link. We go over it. We identify where the issues are and where there's room for improvement, and we get rocking.
That's perfect, man. For you, if you'd like to get a hold of me, there's multiple ways to do it. One of the easiest ways, if you're watching this, obviously on some kind of social media channel, in the section below with the notes and stuff, I have a link down there that's going to be schedule a one-on-one call with me. It's a free, like 15-minute, maybe 30-minute session with me, where we can do a couple things. We could look at credit together, just to give us an idea what's going on. We can look at the home loans together, but it's really just like a planning session to see where you're at and how we can get you to your goal, whether that be refinancing or home ownership and stuff like that. So that's how you get a hold of me on that side. I appreciate you so much, Ryan, and your partnership. I gotta say, I love your picture behind you. What does that represent to you?
It's a red stag. I grew up in Wisconsin in the Northwoods. I grew up with white-tailed deer, but I just thought that was just a nice, powerful looking animal. So it reminds me of home a little bit. I'm here in North Carolina now, so
yeah,
it reminds me of home.
Perfect, man. Well, awesome. I'm going to go ahead and sign off, and we'll talk to you right after this video is over.
All right.